Hello and welcome. My name is Alexander Nikitin. I am a professional trader and a developer of pattern search software. And in today's video, I will continue the series of my videos about the money management and psychology of trading. And today I will talk about the phenomena of cutting your losses short, and I will also talk about some other things like when in doubt, stay out or get out, and the like, how you can implement them in your real-time trading. And before we do that, let me briefly explain the career of trader. For example, we all start as newbies. Yes, let me have it this way: newbie. This is our initial thing. What is a newbie? A newbie is a guy who came to the market to make some money. It is his own preoccupation, and this guy doesn't have any kind of education about the market. Maybe sometimes he read some articles that his broker has written about how easy it is to win, and maybe he read some books, something like Forex Trading for Dummies or something like that, and after reading them he understands, okay, it's not so difficult, so let me just go and make some money. Maybe he had experienced some number of winning trades, 2 or 3 winning trades, and he makes a decision to bet all in because he's the smartest guy in the world. Okay, so these guys are called newbies. They know nothing about the market, and the problem is that they don't know that they know nothing. They don't know, they don't understand that they need education. That's why they're newbies. Okay, and at this stage people simply lose 90% of their account within 90 days. Okay, after that, after you have lost your account and you came to a realization that probably you need to learn something, you need to understand. So at this stage, you know that you know nothing. You know that you know small, and you know that you need to learn more. So starting from here, I call it struggling trader. A trader who struggles to become a professional trader. You know that you don't know something. Okay, so this is the struggling trader. This is my personal understanding of it. So at this stage you read the books, you understand that you need education, you go to webinars, to seminars, to somewhere else, you read a lot, you find some strategy, you come to realization that you need a strategy, you need a plan, you need a systematic approach, and you need some discipline to follow your plan. And at this very stage you also do the back testing, and you do that kind of stuff that is needed for trading. And once you have done your back testing, and once you have written your trading plan, once you have back tested your strategy, and you get the confidence that your strategy is working, you get the confidence that your trading plan was back tested and forward tested, and only after that you become amateur trading. I call them amateur trading. This is my own classification. Amateur, if I'm not wrong with the spelling, it is spelled this way. So the struggling trader is not losing his account that fast that a newbie trader. The struggling trader is moving break even, break even, break even, something like this. Maybe slightly negative because of brokers' commissions, taxes, because of transaction fees, or something like that. And what is the difference between the struggling trader and amateur trader? As far as the equity curve goes, there is no difference. The amateur trader still have the break-even equity curve. This is very strange about that. Although the amateur trader is the guy that is already educated and he is conscious about his education, he knows that he knows something, he knows that if he will execute this and very strategy, he will continue generate some money, but because of wrong money management, because of maybe wrong psychology, wrong mindset, because of lack of some understanding of some minor things, because of the fact that he's not journaling his trade, that he's not writing down his thoughts in his trading diary. Because of that, the amateur trader cannot experience the steady equity rise. He knows how to make money already. Yes, he knows sometimes he's growing very well for months or two, and then he gives his money back. So his trading is very much affected by his mindset. Maybe when he's in a good mood, he's making some money. When he's bad mood, he's not making some money. And very simple situation, as I explained in the previous video, the very simple situation to transit from the amateur trader to a professional trader is simply stop trading when you're not feeling good, when you're not feeling good, or when you're not in a good mood. And how do you know that? For example, if you risk 1% in each and every trade, so if your total drawdown becomes 6%, stop trading for the rest of the months until you are ready for the next month, until you are better prepared. Do the backtesting, do the paper trading, read more books, especially psychological and money management books, as they are more important. And next trader, you will be in a much better state, in a much better mood, and I bet your trading will propel this way. Simply stop trading. That was the advice for previous lesson. Amateur trader. So to make a shift from the amateur to professional trader, you have to forget about your strategy. You have to forget about your complicated methods. You have to forget about your system that you have developed and that is very, very complicated. What you have to do, you have to make a step back and learn the basics. If you will not learn the basics, you will never shift to professional trader. Learn the basics. Today we will talking about this shift, about this transition, and we will talk about the basics. Finally, if you don't give up, if you learn the basics, for example, you have backtested your strategy, it shows the positive expectancy based on your numbers, and you simply cannot repeat the results of your backtesting. You seem to do the same. You are sure that you are doing the same because your backtesting was done with the indicator and you are trading with your indicator, but you cannot achieve the same results. Why is that so? Was your indicator simply fitting the history, something that fit the history, and that's why it was performing good on history and it's not performing good real-time trading? Was it that? Who knows? Maybe, maybe not. And I hope your indicator is objective and the problem is purely psychological. And to resolve that problem, you have to go back and learn the basics. And when I say basics, you have to learn the very, very beginning of how to read the price chart. You have to learn what is the price bar, what is a trending bar, what is a consolidating bar, what is outside bar, inside bar, whatever. Simply from that. Then you will learn slowly what is a swing high, a swing low. And then you will slowly learn what is a trend line. It's simply a line connecting some swing highs or swing lows. And then you will learn what is the patterns based on swings. And then you will learn more and more and more. So go back to basics. Only then you will become a professional trader. Now we are going back to basics. Trader. So I assume you are somewhere here. If you are not here, then you need a strategy. I will suggest you to use my strategy because I'm a pattern trader. Just go to www.ps-software.net and wait until it loads. Then go to Learn the Patterns tab. Learn the patterns. This is the very accurate strategy called harmonic pattern strategy, and an aggressive variation of harmonic pattern strategy is called advanced pattern strategy. Simply click on the picture to get the detailed description of the strategy. So, well, I'm not telling you that you should trade it exactly the way it is written on this website. They are the rules for identification, they are the rules for trade execution and trade management, the three components that are needed for each and every strategy. You have to do the backtest. Maybe you will write down your own trading plan based on these strategies. Then you do the backtest, and this way you will make a shift from a struggling trader who knows that he needs something, that he needs a strategy, that he lacks some knowledge, into amateur trader who already has a strategy and who knows that this strategy is working. How does he know it? Because he's done backtesting. Okay, so today we will talk about how to shift from amateur to professional. One tip was given in my previous video, so watch my previous video. It was about money management. And today my tip will be mostly psychological. And in few words, I would explain it this way. Cut your losses short, let your profits run. They are very, very old sayings, but they tell you nothing until you hit the wall with your head. Until you hit that problem and you cannot transit from one stage to another stage. And the second will be when in doubt, get out, or another variation of it, when in doubt, stay out. So it is when you have a trade, then get out. When you don't have a trade, then don't enter. Okay. Why do you need the basics? You need the basics to listen to the market. What is the problem with amateur strategy, with amateur traders? Amateur traders already know their strategy. Yeah, they know something about the probabilities, they know something about the strategy, and they know if I buy it here, there is this probability that price will reach my take profit, a higher probability of that, and there are lower probability that my price will reach stop loss. Yes? So these are the beliefs of an amateur trader. Yes? A professional trader, the one who knows the actual probabilities, he says, you know what? In this particular situation, the probability of hitting your take profit exactly the same that the probability of hitting the stop loss. 50%. It will either go there or not. But over the course of a large number of trades, yes, we will have more likely hitting the winner rather than the loss. But right now it is not that. So what I am to do if I don't have any belief about the market situation? Yes, what I am to do, I am listening to what market is telling me. If the market is showing me some signs of bearish momentum and it tells me, you know what, I'm not going to go higher, simply close your position with whatever profits. This is what professionals do. Or close your position if it is maybe moving this or that way, showing some bearish signs. You simply close it with a small loss rather than wait for your full stop loss to be hit. These simple differences, simply looking at the price action and simply understanding these basic movements, some basic chart patterns like flags, pennants, double tops, double bottoms, head and shoulders, inverse head and shoulders. These simple price action patterns that are known in technical analysis since I don't know the 1880 something, when Dow Jones first explained his when Charles Dow first explained his theory and founded his Wall Street Journal. Starting from that, it was already known how the price is moving, that it moves in trends and blah blah blah. Okay, well, now let's go. Let us start. it will take for a while, so take a pencil, take a paper, take some notes. This will be very valuable for you if you are an amateur trader. You may say, okay, shut up with that basic stuff, I need your strategy. Well, you may go and start trading it immediately, but don't shift your responsibility to my strategy. The strategy is not responsible for your losses. Neither me is responsible for your losses. So the only one who is responsible for your losses is you. Listen to the basics. The definition of an uptrend bar. An uptrend bar is a bar that has a higher high, this is the high high, and higher low above the previous bar. Simple? Yes. Uptrend bar. Yes. Uptrend bar. Uptrend bar. Uptrend bar. Okay. The downtrend bar is the bar that has a lower low and lower high below the previous. So this is the downtrend bar, downtrend bar, downtrend bar, downtrend bar. The point, the transition from uptrend bars into downtrend bars is called a swing high. You see that? And if you unite that with this trend lines, you will have this. And if you are trading some swing trading strategies, you would first need to analyze the market this way. Draw your swings. Okay, uptrend bar, downtrend bar. Now, what if we have this way? We have downtrend bar, then we have uptrend bar, and then again, instead of continue an uptrend, we have downtrend bar, like this. And again, instead of continuation, we have an uptrend bar. What is this? These are called consolidations. Consolidation. You see, sometimes the consolidation looks this way. Very rarely, but still it may look this way. Equal highs, equal lows, but it's rarely. Typically, the highs and lows are hitting here. Okay, what is the identification of this consolidation? What is the rule for consolidation? That the bars are overlapping each other, overlapping very much, overlapping the ranges, and they move in a horizontal manner. And of course, when you have an inside bar, the bar that is lower than previous range, yes, you are staying within consolidation. This is a consolidation bar. And when you have an upside bar, outside bar, yes, this is also a consolidation bar. Inside bar, consolidation bar. Outside bar, consolidation. How many bars you need to identify consolidation? My rule says that to identify consolidation, I need at least 4 chunking bars. So this chunk, 1, 2, 3, 4, when I cannot say where the market is heading, here I can obviously say down, 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 down. Here I said up, then I say down, then I say up, and then I say, wait a minute, up, down, where the market is heading to? Make sure that this is a consolidation. 4 bars is enough to confirm that consolidation. Consolidation bars, uptrend bar, downtrend bar. Easy, yes? Okay, so what are those consolidation bars? They are typically formed the so-called flags or pennants. The pennants and flags are continuation patterns. Guys, but don't be that very much sure about those continuations, that it is only a continuation and something like that. No, sometimes when it is broken to the upside, it is a reversal pattern. Yes. Of course, depending on this situation, we may have the bars moving slightly lower, higher, something like this, and they may be this, this, and this. And the trend lines that unite those bars may be sloping slightly. So this way we have triangles, symmetrical, ascending, descending. It doesn't matter. You should know the overall idea, that the bars are not showing one direction. This is the clear direction of an uptrend. This is the clear direction of a downtrend. If the direction is not clear, it is consolidation. Unite the highs of bars and lows of bars, and you will have either a triangle, either a wedge. Let me show you the most common patterns. So this pattern is called the flag. The bars are horizontal. So the next pattern is called a pennant. So the bars are having a lower and lower range. So the highs are ascending, the lows are descending. Oh, sorry, vice versa. The highs are descending, the lows are ascending. Okay. Next, what is this? This is the wedge. Something like this. Although you have them moving higher and higher and higher, but the range of these bars becomes smaller and smaller and smaller. So this is the rising wedge. The rising wedge is a continuation, continuation, continuation. So these are very, very basic patterns. Okay, now let's talk about the reversal patterns. The first reversal pattern is this wedge. If I talk about wedges, then this is the wedge. This is a reversal pattern. We have larger bars, yes, but then we have smaller, smaller, and smaller. Although it looks like a downtrending bar, the range of that downtrending bar, each bar becomes smaller and smaller and smaller, like this. And now they are equal. Let me make them gradually smaller and smaller. So instead of having parallel channel to the downside, by the way, guys, if you unite the highs of this, you will have parallel channel to the upside. If you unite the highs of downtrending bar, you will have the parallel channel to the downside. So the downtrending bars are parallel channel. You have convergent trend lines. So this is the wedge when they are convergent. And if it is broken to the upside, then you have a reversal pattern. Okay, they are very, very simple patterns. Now let me explain you the double top, double bottom. So what is the double top? You first should have a series of uptrend bars, or to say it very, very simple, an upswing. Then you should have a series of downtrend bars, or to say it downswing. It should not be a consolidation, it should be a downswing. And typically this high should be a sharp reversal. What is the sharp reversal? Is the reversal that shifts from an uptrend to the downtrend. The bottom of that should be also the sharp reversal. In the majority of cases, it is also a sharp reversal. And now, what is a valid double top? The high of this bar should at least touch the area of the close of this bar. You see, it should touch the area. If it doesn't touch the area, it is considered a lower high. You see, a lower high of a downtrend. Boom, 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 boom. But if it touches the lowest, the close, then it is considered a double top. This high should be considered equal. Okay, the high of this bar can also exceed this high, you see, but it cannot close above the high. If it closed above that, come on, close it. If it closed above this, then the double top is invalidated. So the situation when we have it this way, how can I drag it? Just below the high, we exceeded that and closed lower, is a valid double top. You see that? So the high of that bar should touch the close of previous top, and the close of that bar should not close above the previous top. This is a valid double top. And for a confirmation of that double top, yes, you need to have a series of downtrend bars, finally breaking the V point. This is the V point of the double top. We should finally break that. This is the confirmation of the double top. Okay, hope you understood that double top. It is very important in pattern trading, very, very important. All these patterns. I hope you are taking notes. Then after you have taken notes, you may look at the chart and identify. We have a pennant, a flag, a wedge, rising wedge. We have a double top. We have a head and shoulders over there. Okay, head and shoulders is different. So this is a number of uptrend bars, or to tell it simply, upswing. Then we should have downswing. Then we should have upswing. So here, ideally, here and here, we should have sharp reversals. Then we should have head. Then we have this, and this. So this is actually the swing trading pattern. And when the neckline of that is broken, you enter short. So it depends on how you identify the swings. And your swing identification very much depends on your ability to identify uptrend bars, downtrend bars, and consolidation bars. Okay, how it is related with pattern trading. Okay, being a swing trading strategy, a pattern trading is actually the strategy that exploits support resistance trading. Whatever swing trading strategy is the strategy that exploits support and resistance trading. Because here we had some reversal, there is a higher probability of price to reverse here as well. And if those swings are specifically Fibonacci related to each other, the probability of reversing here becomes even higher. And to prove us that the market is not going to work, imagine that this is a large double top, yes, we simply need to close above. The simple rules for a double top. We don't need the large distance for a market to go to tell us that we were wrong. So we suppose that this is a double top, and we are supposing that the market will reverse. So there is only small distance required for that. So in comparison, this risk to compare the reward is actually the retest of this low. This is the full potential of the pattern, is very, very nice risk to reward. So this is called the low risk opportunity. The low risk because it is compared to potential reward. Okay, so you should first know what you do. You are exploiting the support resistance trading. There are three types of reaction when the resistance is met. The first type of reaction is this. Boom. Very simple. You have your targets hit. The only thing you need to do, simply wait until it's hit when the price action is this. So what it means, the price action is this? It means that you have a number of what? Answer it yourself first, and only then watch me doing that. You should have a number of downtrend bars in your favor. That's it. This is what is called a straight reversal. Okay, next. Second situation, the second reaction for that is this. Price action moves, boom, and simply blows that resistance as if there is nothing. So you also know what is it. You know that it is a number of uptrend bars moving higher, higher without stop. They are uptrend bars. so it is broken. No need to stay in your trade. That's why you have your stop loss. You just get out. Okay, and one of the most common situation is that the market goes here and then it starts doing this chunk. It goes lower, it goes slightly higher, then it goes lower, then it goes slightly higher, then it goes lower. So this chunk is one of the most situations within this trading, within this support and resistance trading. So answer the question, what is the probability of price to move, either higher or lower? What is the higher probability of outcome? Of course, the highest probability is to move higher. Okay, so in pattern trading, when you see price consolidating around your entry, maybe giving you small winner, small loser, 2 pips in your favor, 2 pips against you, 2 pips in your favor, 2 pips against you, the 4 to 5 bars is enough to understand that you are stuck in consolidation. If you're stuck in consolidation because the resistance level is very high, is very close to that, your most outcome is the upside. You see that? Look at this. If we don't calculate these situations, if we don't calculate them, the outcome of price to sharp reverse is 70%, and the outcome of price to blow your trade off is 30%. 70% that it will bounce, 30% that it will break. Okay, now if we include consolidations, the longer it consolidates, the higher is the probability that it will finally break to the upside. So it is adding losses to us. It is adding more to losses, and the probability of moving to the downside is small with this consolidation. So we are adding more to losses. Instead of only having 30% of losses, we are having 40, we are having 50, we are having 55, and so on and so forth. But if you get out immediately, if you have this consolidation, you will, in majority of cases, you will either exit with a small profit of 2 pips or small loss of 2 pips, small profit of 2 pips, small loss of 2 pips. So overall, this consolidation situation will give you 0. They will give you a break-even results. You see, instead of adding a number to your losses, you adding 0 to your losses. See that? Okay, now let me explain the psychology behind that. What is this? So this is the resistance level. A large player knows that the majority of traders will be going to sell this resistance. If they are going to sell this resistance, they are placing their protective buys above it. You see that? Above that. If I am to execute, let's say, 1,000,000 of lots, if I execute my first 1,000 of lots or 2,000 of lots, I push the market down. Yes. If I try to execute all the 1,000,000 of my lots at market, there won't be enough sellers at the price, and I will be executed higher, higher, and higher, and higher until price reaches the sky. It's not good for me. You see that? I'm having worse and worse price for execution. But if I execute, let's say, 1,000 of lots, yes, you see, I find buyers that will, sellers that will sell me that 1,000 of lots. Then price retraces a bit because a number of sellers push it down. I buy another 1,000 of lots, maybe 100 of thousands of lots. Yes, then sellers push it down. I buy another 100,000 of lots. Yes, then sellers push it down, and then what I do, I buy 500,000 of lots, and it leads to breaking the range. and once the range is broken and this level of protective stops is hit, those sellers, what those sellers do, they cut their losses. They turn their selling positions into what? Into buying positions, and this leads to accelerating the position. You see, I was slowly increasing my position here, buying 100 lots, another 100 lots, another 100 lots, another 100 lots. Then I have bought 500 lots. The market pushed to the upside, executing the buys of the sellers, yes, and after the buys of the sellers executed, price accelerated. You see that? And here I close my position after that. And typically after the breakout, we see what? We see retracement, because large positions being closed here. I close half, I close a bit, I close a bit, I close a bit. I close. If I close it partially, close partially, then I will be closing to some fools who are trying to buy it here. I close it partially until I fully exit it. You see that? So just below the resistance is this market behavior, market psychology, market participants. It's not only one person that does this. This is the collective traders. They are trying to fool those support resistance traders, those newbies struggling, or amateur traders who know that resistance should hold. This is called the stop loss hunting, or whatever you call it. It doesn't matter. You see that? It is a guaranteed money for me. If I have enough money to move the market, I will feed the market with small positions, buying near the resistance, because I know, because near the resistance I have plenty of sellers, and I know that I just past the resistance I have plenty of those sellers turning into buyers, and if I push the market there beyond the resistance, boom, I have profits. And I don't care about economics. Maybe the economics is the worst case scenario. I don't care. What I really care of is that making money, to generate money. This scenario is almost a guaranteed money making. So if you will hold your position here, you are a pattern trader, for example, yes, and you see it moving this way, you are a fool. You see that? You simply, because you don't know the basics of how to read the price chart, you ignore that knowledge. You are keeping your positions. You don't close them. At least what you can do here, just tighten your stop. Instead of having the full stop of this 180 above that resistance, tighten your stop lower. Yes. Or just get out immediately, or wait for a break, the first candle close above this, and get out after the break. Don't let your losses. Okay, another example is considering the target profit taking. In majority of cases we have it this way. Let me delete this stuff. So this is the pattern. Okay. And this is especially true for a Gartley pattern. A Gartley pattern is somewhere 786, and the B point should be this, yes? So this is your resistance level, yes? This is your entry, a bit lower than resistance. Well, it happens then. So starting from here, price goes this way, and then it starts hesitating. Let me draw the Fibonacci to explain it. This is it. This is your level for target taking, for profit taking. This is your level. Okay, what price does? First of all, let me do it this way. Your entry executed. Oh, my cat is moving my mouse. Hey, come on. Hey, Sorry for that, guys. My cat was playing with my wire of my mouse. Okay, you have the downtrend bars. It is moving into your favor. Yes, downtrend bars. Then you have uptrend bars. And you have a valid double top. But next bar does what? It closes above. So what you do, instead of waiting of price to hit your full stop loss, that is here, just exit immediately after this double top is broken. Pretty simple. Price is trending to the upside. Why should you stay? You want your full stop loss be hit? No, of course not. Next, another thing, profit taken. Yes, I wanted to explain some profit taken. Price moves this. I will only tell about, let's say, 382 target. Yes, the range becomes narrower, narrower, and narrower. You see it this way. It was kind of moving faster and then became narrower, narrower, and narrower, and it is called an ascending wedge. Yes, your profit wasn't executed, and after that you have it this way. Break to the upside. What you should do? Close your profits. Don't stay in the market, because there is very high probability of price to you will give all your profits back to the market. Don't stay in the market. Don't be stubborn. The market is showing the signs that it no longer wants to go lower. It gives you the hints that it is trying to move higher. Then don't stay it. Don't wait until the 382 is hit. You may never get this. So in the majority of situations, you never have your 382 hit. Well, in not the majority of situations, but in the majority of situations when you have this wedge pennant or whatever. Okay, another situation, just simple price pattern trading. Simple price pattern trading. Let me delete that, delete this, and delete that. You have it this way. You have uptrend, yes, 3 bars, they are called uptrend bars, and then you have it this way. Okay, so guys, don't wait for price, don't dream that it will continue to the downside. Get out immediately. What is it? Consolidation. What is consolidation? The consolidation is the sign of what? Of continuation. You see that? Here's your uptrend bars, 1, 2, 3, 5, or whatever. It will be a continuation. Okay, now what is remarkable about pattern type analyzing versus support resistance analyzing, that the pattern type pattern analysis is much more powerful than support resistance. So first of all, the pattern appears, let's say it this way. First of all, the pattern appears, yes, and if you draw the horizontal line this way, like this, you see that it is a level. It is not that the first you have a level and then the pattern appears. No, first the pattern appears, and only after the pattern appeared you understand that this is a critical support or resistance level, like that will most likely be broken this way. And of course this is a very good situation when you have it this way. Buy it, boom, you see that? Very good situations to go with the trend. The patterns rule. pay attention to patterns first, and then to levels, to supports and resistance, and then to structure, the so-called structure. First, the patterns. They will tell you what the market is going to do. Okay, now let me explain you another pattern. This pattern is an Elliott wave pattern. So you know that the price is moving in 5-wave pattern. Yes, upside, upside, and this explanation is not very correct. First of all, if you would read the Frost and Prechter's book, The Guidelines for Elliott Waves, you will know that the first wave is most likely a deep wave, and the second wave, not the second, retracement, first retracement, and this is the second retracement. Actually, this is wave number 2 and this wave number 4, yes? And the wave number 4 is shallow retracement. And you know that wave number 3 is typically the largest one, but it is at most not the smallest, yes? It may be equal to this and equal to that, but it's not the smallest among them. Okay. It is either the largest or the second by the length, if judging by the length. Okay, so what is this situation? The Prechter says that the most obvious pattern is this. When you have it this way, you have wave number 1. Yes, let me delete this. Wave number 1 with a kind of deep retracement, and then you have wave number 2. Yes, sorry, wave number 3. Wave number 1, wave number 2, that is a deep retracement, and wave number 3, that is an extension. Yes, and then you have price action making something of this kind. Okay, and the Prechter says that it is the 70% probability that right now we have wave number 4, and what a good Elliottician do, he will buy it as soon as it broke into the upside. Is this sounds familiar to you? Can you see this part of chart and kinda support the previous part, kinda guess about the previous part? Yes, of course. If we have a leg here, what is this? Our stop loss here. We have our bad pattern. See this? If there is a 70% probability of price to hit our stop loss, should I stay in this bad pattern? No, of course not. There is the 70% probability of price to move the 618 distance of these two. If you don't know how to calculate that 618 distance, you are to use the Fibonacci trend-based extension. Okay, you measure it from here to here and you project it here. You see the trend-based Fibonacci extension, and then you go to settings, go to style, and enable 0.618. You see that? Oh, my eye is perfect. 0.618. Okay, guys, I will come back in a second. Okay, I'm back again. So from the course of that and back to the beginning of this, the 618 is the target for the wave 5. Elliott wave patterns, 5 wave to the upside, to the downside. And Pritchett says that he doesn't care about the previous stuff. He cares only about this. What was it? Let me delete that. He cares only about that most recent price action. And if he sees this, he will enter buy. He will enter long. Okay, and that's all true about the reverse, about the bullish patterns. Well, now let's move into charts. Let me see what happens in markets. Let me load my 15-minute template. I saw some patterns there. Okay, pound yen. It was signaling me that we are close to our entry. Okay, guys, so what I'm looking here, I'm looking to execute my sell at this level, and we have this thing here. So if I have that triggered and then I have downtrending bars into my favor, then it is okay. If I don't have them, if I have them consolidated, then I will move it a bit different. Okay, now let's go to where? To default profile. It is dollar Canadian 15-minute. Okay, let it be dollar Canadian 15-minute. Monster pattern search. Manual, no manual, automatic, extra large. Let us see all the patterns that are possibly, and let's do the backtest of the history, and you will see how I exploit this basic stuff for pattern trading. And Gartley, Bat, Cypher, Butterfly. Let's disable Butterfly. Okay, only 3 patterns here, and to write them down, let's have an Excel spreadsheet. An Excel spreadsheet will look this way. First of all, we will have our stop loss in pips, then we will have our take profit in pips, then we will have our risk reward, and then we will have our result. Okay, the risk reward equals take profit divided stop loss. Okay, and let me stretch this. We will type in some trades here. Okay, so the monster pattern search will draw the patterns on history, and I will be trading them, trying as if it is real-time trading, yes, and I will show you how these rules work. Cut your losses short, when in doubt stay out, or get out, and let your profits run. This simple 3 statements, how they improve the results of trading. Okay, let's go initial day, the starting day, and the first pattern we have is this Gartley pattern. Oh, by the way, let me switch that from lines to what? To draw prices. You see, this Gartley pattern is in our play. Before we see what happens, let's first see the entry. 24.41.6. 24.41.6. Okay. 24.41.6. It will take for a while, but it is needed. 24.41.6. 41.6. Okay, so what we can analyze here? We had some movement, we had some consolidation, we had some movement, and this movement was, if compared to previous, yes, trending bars, it was kind of overlapping, and then small trending to the downside, to the upside, to the downside. It can be what? It can be wedge pattern, yes, something like this. So those wedge patterns that initially we have patterns. The pattern is this. It indicates that we have kind of support here. The wedge patterns are the patterns that are indicating a support pattern. Okay. Then what is my decision? If price goes and hits my entry, then I enter. Yes. If price consolidates near this entry, then I either will get out if I was triggered, or I will be very cautious about that trading, and maybe will cut my losses. Yes. So this is the decision. Let me move the market bar by bar and see if it goes to trigger my enter. No, it didn't. Okay, perfect. Then let's go next. Our next pattern is this potential cipher. Let me go bar by bar. Come on. Okay, slowly going high and high and higher. Come on, let's go. First of all, what I should look at, I'm looking at this resistance. Yes, you see that? The resistance. Then the resistance was broken to the upside, but no uptrend. Uptrend was continued. We broke to the downside. So this may be called a false breakout, after which we have a downtrend. Yes, and then we have this cipher pattern. Okay, what we should know about this? First of all, the cipher pattern's entry is above this resistance. Keep in mind that it is above this resistance. If I unite this high, you see, high, the cipher pattern entry is above this resistance. I should be very cautious if price shows a very strong upside movement of this bar, let's say this way, boom, above the resistance. Most likely I'd rather get out of this trade, otherwise it would be a stop loss. Yes, let's go higher. Let's see the price action. If the white expansion bar, I would stay away, maybe, or maybe try to close it with a small loss. Oh yes, this is what I was talking about. You see that price came to the upside and closed above the resistance. Of course, I was in this trade because I was spiked through my entry. I was spiked through my entry to the upside, and then I retraced slightly to the downside. So my decision is here is to exit like this. 7.9 of win instead of 37.1 of loss. 37.1 of loss, 7.9 of win. So we actually have what? We have it this way. And the result was that, you see, simple understanding of the price action. It is, I don't know, it is very simple. Wide range bars that break above the resistance, well, simply be a bit careful. We have the resistance, we had the false breakout, we had that second attempt, wide range bar, and our entry is above the resistance. So who is selling above the resistance? We should sell at resistance. We should sell a bit lower than resistance, but who the hell is selling above the resistance? Okay, another pattern. It is a godly pattern. Let me see what it gives me. Okay, now you should look at this. We have that uptrend, yes. Then we have downside, and then we have this downside. Guys, this may be a pennant formation. Of course, to execute my entry, it will be a pennant formation, pennant or flag formation, whatever you call it. It will be that. I'm not cheating. You see, I'm moving bar by bar to actually show you the history. It appears in front of your eyes. It is not something that that I know what will happen. How can I know that? Moving that bar by bar. Okay, this is the price action. So what is my decision here? My decision is to be very careful. So this is the pattern. Let me extend the trend line ray to down to this. Yes, so we have this thing, we have this pennant, and then it is broken to the upside. So odds are in the favor of moving higher, and the movement higher will equal to this movement. Yes, well, we may have the situation this way. We may break it and close that, and then we may retrace back. Will this retracement be enough for us to take targets? No, I don't think so, at least in this situation. So when in doubt, you see, I'm having doubts right now. Should I enter or not? The Gartley says sell, pennant says buy. When in doubt, stay out. Of course, I don't enter. So my decision, not to enter. Well, what can I say? I can say nothing. That was a wise decision, very, very wise decision. Okay, let me delete that stuff. Perfect. But guys, it could be a winner. I suppose it could be a winner. Yes, a 382 winner. It could be a 382 winner, but I stood out. Small winner was missed. Oh, sorry. Okay, what is this? Well, I already saw what will happen, but we will try to examine our bar by bar according to rules. Yes. Nothing. So until that, yes, I don't know what will happen until this. So if my entry is 886, my entry is 28.55.8. 28.55.8. So I am to place my entry at 28.55.8. 28.55.8. Okay, perfect. So this is my entry, yes. And just below I started the movement to the downside. Upside, downside, 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 and then it blew my stop loss off. Yes, so no doubts, I have a stop loss here, no doubts. 55.8. So it was what? It was 12.3 for loss and 14.7 for win. 12.3 for loss, 14.7 for win. 1.20, but this time it was -1 because it is a loser. -1 means -1%. This should be numbers as well, I suppose. Okay, let's go next. Delete this. Let's move it slowly. For next time, not to see what will happen in future. Okay, what a Gartley pattern brings to us. Let me see the C point and the B point. Okay, it looks this way. Here and here, yes. Okay, double bottom here, then we have it to the upside, and look at this situation. In this situation we have it this way. If I enter here, I still have some space for a retest, yes, to have a target of trade 2 at least, yes. So that's why I'm planning to stay in this trade. My Gartley is 127. It may be a wise decision, maybe it is a mistake. 127.82.1, and you can see it is a red candle, triggers that, so it should be this. Let me have it this way. Okay, and now let me manage this position. Yes, let me see what price action gives me. It's going lower, trending to the downside. Good, good. Okay, it is perfect. Perfect winner. Not only hitting the first target, but also the rest of them. Okay, now let's calculate that. The target looks this way. Yes, first target trade 2, and the stop loss is that. So my potential stop was 14.2, my target was 9.2. 14.2, 9.2, and it was a winner. Not all the patterns have positive risk-reward ratio, but if you manage them properly, if you immediately cut your losses, in the long run they are positive with your risk-reward. I will explain that a bit later when we have that situation to talk about. Okay, let's go next. This is the cipher pattern, and here's the situation. Yes, we have kind of resistance here. This is resistance, support, resistance, resistance, broken resistance, good resistance, another good resistance, and here it is. If it will consolidate below this resistance, that get out immediately. Yes. Then let's calculate the entry. 27.63.7. 27.63.7. Let's go and place the entry. 27.63.7. Okay, perfect. So this way I was in this trade. I triggered. Yes. Let me disable that zero description. Okay, you can see it perfectly. So what I do, I simply restretch my Fibonacci and my targets are slightly adjusted. One more bar moves in my favor. Another bar is moving in my favor. You see the bar, lower low, lower low, lower low, lower high, lower high, lower high. So they are trending bars. Lower low, lower low. Okay, lower low, lower low. Moving into my favor, and finally hit the take profit. You can see that. Okay, and after the take profit, hit it, reversed and went back. But I don't care. The further price action, trade 2 is my target. Then my stop loss was 21.3, and my target was, come on, 17.2. 21.3 versus 17.2. 17.2. Okay, so it equals this. Let us go next. Delete that. Come on. Here we have a larger Gartley. Yes. Let us see the B point and see the C point. Okay, now if it moves higher, what we have here, we have a resistance, then we have that false breakout, a similar situation to the one we had previously. I don't know what it was recently, you saw that. Yes, similar situation to that. If it consolidates here near that, by the way, the entry is higher than this resistance. Who the hell is going to sell above the resistance? You see, it is very nice resistance level. Who is going to sell the resistance? Okay, slowly, not to see what happens next. Okay, my entry is this 127. It is 28.18.1, 28.18.1, 28.18.1. Let me show you. So the entry is this. This means that I am looking to sell above the resistance. So what is my decision here? Do not enter. Pretty simple. Don't sell above the resistance. Okay. Okay. Let us see if I was correct. You see, I am not in this trade. I remind you, I'm not in this trade. I'm not selling it. By the way, this is the resistance, another resistance, yes. If I'm not in this trade, yes, I'm not in this trade at all. But suppose you entered this trade. Look at this consolidation. Yes, like this. So you were triggered, and then you go to the downside, to the upside, to the downside, to the upside, slightly to the downside. This is what I call the consolidation, yes. And then range trading. So this is exactly what I mean. Price does not go to your target. It is moving sideways, consolidating. And I don't know, 3 to 7 bars is enough to understand that. So the pattern is most likely, it won't work. It most likely not go to your target. Although you may argue, you may say, okay, we have top, top, triple top. And then we have a break and close below the triple top. This reinforces our godly, we should enter short. I bet you should not. Stay away from that. You will save your money. Now let's see if I am correct or not. I may be wrong. I know that I may be wrong. I just simply may miss the profitable opportunity. It happens, yes. But believe my experience. First of all, who the hell is selling above the resistance? Second, consolidating just below the higher resistance is not a good sign. And oh, look at that. Yes, the stop loss was this. Hit here. Yes, perfect. And after that, it reversed. Well, who cares about when it reversed after you closed your stop loss? After you have your loss. Do you care about where it reverses? No, you just closed your stop loss. Okay, no trade here. Perfect. Let's go next. These are simple rules for, I don't know, how to read the price chart. Simple rules. First look at the formation, then look at the levels, then look at the price action, how your position goes. If you enter at all, if you have doubts, stay out. I had some doubts, I stood out. That's why no trade with me. No trade with this pattern. Going next. Just avoided a loss. Okay, we have a kind of pattern here. A bullish pattern and a bearish pattern, yes? Come on. What we have here? Oh, another bullish pattern, but a bit smaller. You will see that in a second. Okay. What we are to do, we first to trade the first pattern, yes? The first pattern is this. This is this one and this one. Yes. So this is the first pattern. This is the level of support, and let me show it to you. It was previously a resistance, it was previously a support, then it was broken, then it respected, broken, respected. I am to buy below the support. So my personal view is not to buy it. And next, what I see next on this chart is this. Look at this. What is this formation? Disable ray. So we have a shoulder, we have a head, we have another shoulder, yes, like this, and then we have it to the downside, yes. So this is actually what is called the head and shoulders, and if it is broken to the downside, it is typically a sign of continuation. But look at this neckline, it is sloping to the upside. We may have a reaction to the upside. We may have a reaction to the upside, some kind of break of trend line and retest, break and retest. Let me delete that stuff. Let me place that resistance support level here. Okay, so what I think about this trace. First of all, I have some doubts because it terminates just below the support level, below this. This is an intermediate support. This is not the external one. Intermediate support, kind of internal, something that is hidden, but it gives me some doubts. And well, let me do it this way. I will look at some further price action. If it consolidates just before I enter, then I will not enter that. If it doesn't want to give me the trade, then I will not enter. Okay, still have doubts. Still have doubts. Okay, let me put my entry here. I can, even if I open my trade, I can always close it as soon as possible, yes? Okay, so the entry is 28.310. 310. Oh, 31.9. It was 31.9, not 0. 31.9. This is the entry. Now let us see if it happens. Because this support resistance level is not that obvious as the previous one, that's why maybe it will work. Okay, so kind of neutral, not bearish. We had that break of neckline for the head and shoulders. That makes me bearish, but we still have some room to the upside, and we can easily have a retest to the upside. And another bearish sign that we should execute below this support level, and well, let me ignore that. I may pay for that. I know that I may pay for that with my real money if I ignore this. I'm in doubt. I'm thinking, well, okay, kind of puzzle for me right now. I'm puzzled a bit because this price action is pretty good. It is pretty fine for me. So nothing tells me that it is going to blow my pattern out, blow me off. We may easily have a small retracement of 380. Okay, I'm in. Okay, what is this? The low of this candle says 28.31.8, 28.31.9. So I am in with this candle. You see that? With this candle, 28.31.9. And now let's go it. Moving lower. Okay, just against me. It just targets. next bar is higher, but still adjust targets. Okay, if we move consolidating this way, I will get out. I will get out. I won't stay in this trade. Move lower. Okay, stay in the same. Move higher. Okay, now I have 4 bars here. 1, 2, 3, 4 bars. They are moving the way I told you recently. Yes, the consolidation bars. 1, 2, 3, 4 bars. I will exit at market next bar. By the way, I am to adjust the targets to 382. So you can see that one bar was lower. Yes, the next bar is showing uptrend bar. Next bar is showing downtrend bar. This bar is an outside bar. You see that? Downtrend bar, uptrend bar, downtrend bar, outside bar. 4 bars. Consolidation is almost confirmed for me. One more bar and I will exit that market. Okay, inside bar. Okay, cut my losses short or wait for the next bar. Inside bar after the outside bar. One more bar to wait. Okay, yes, get out at this price. Okay, so I am exiting at this level, 1.9 pips. My initial stop loss was 1% for what? 8.8 pips, and just cut it for 1.9. Instead of 8.8, I have 1.9. If I divide 8.8, it equals 0.215. So it is not full percent, it is 0.215%. You see that? Let me type it. My loss is 1.8. You see that? And here I have 0.215%. So it's 0.25%. This is my loss here, 0.22. Okay. Okay, good. So let us see what happens. It went closer to entry, but it changes nothing. I'm still very bearish on that. It changes nothing. It goes a bit higher. Well, it changes nothing. You see that? It was a stop loss. It would be a full 1% stop loss if I didn't close that. You see how the market is making me doubt in my decision. I know that I am bullish for that pair because of that bullish Gartley. I know that I'm kind of right in my analysis. It was back tested and forward tested and blah blah blah, but the market is making me to change my beliefs, and it tells me, don't be stubborn, change your beliefs. Okay, the potential profit could be 9.7. So the risk to reward is, oh no, it was 1.9. It was my stop loss. 9.7 is my take profit. So the risk to reward could be 5.11. Okay, what we have next? Let me stretch the fibs to a higher Gartley, and nothing stops from a higher Gartley. Same situation, but here we have a wider space to the neckline. Yes, if we treat this as a neckline break over head and shoulders, we have a wider space, and also we have a wider space for this support resistance level. Yes, we may bounce to that. For me, it is better to have it this way, and to mark that support level, pretty cool here. Close above but immediately higher, close below immediately higher, and well, I'm buying above resistance. I still have room to the upside, although the market is overall bearish. I still have some good opportunity to buy it. So if the price action says opposite, I will buy it. I will buy it. executed here at this bar. I'm making the adjustment, yes, the target adjustment from initial to the lowest. Okay, next bar. Boom. Immediately sharp reversal into my favor. Good sign. I'm not consolidating, I'm not hesitating. I move sharply towards my target. Okay, then I move slightly beyond, that's good. Then I move slightly above, that's good. Then I move slightly beyond. Now look at this. I made this all movement to the upside. And now I am consolidating. But the previous movement was uptrend. Consolidating and uptrend. The odds are in the favor that this consolidation will continue to the upside. Until we have, of course, a rise in wedge consolidation. It is a reversal pattern, but this is a pennant pattern. It is indicated to the upside, so I stay in until the target is hit. Okay, had a lower and then I have higher. Perfect. Okay, you can see that consolidated a bit and finally broke to the upside, so this is a consolidation pattern. Let me draw it. Initial stop loss was 20.8 and take profit was 20.9. 20.8, 20.9. Stop loss 20.8 and the take profit 20.9. And I have won. That equals my winner. Let's go next. By the way, this yellow is a bad formation that is setting up. Oh, sorry for that. Okay, what I have in this bad formation, I have actually the same price action as I had here, so the same level here, yes. So I bought it, it worked pretty cool, and it was a Gartley pattern, yes. And after that I broke and closed above that. This is an uptrend, so nothing stops me for buying. And I have my entry 128, 21.8, 28, 21.8, 28, 21.8. If I reverse it this way, 28, 21.8. So my decision is to enter this trade, and I will exit as soon as price action gives me the sign of not going into my favor, yes. Okay, so simply enter, look at this, touch and go, and simply going higher. So nothing should be here, nothing should be changed, should be explained. This is pretty simple, limit order entry as usual. Okay, touching the take profit here. Pretty simple, 1-2 bars and the profit is hit. So this is how patterns should work. Okay, let me go to the entry and stop loss. If they are hesitating, consolidating, then you should get out. 16.4 versus, sorry, 16.4 versus, the entry was this, 26.3. 16.4 versus 26.3. 16.4 versus 26.3. This is the winner. Perfect. Next, we have a Gartley pattern setting up. Okay, now I will move bar by bar. Okay, it triggered. Nothing stops me from triggering this pattern. You can see it. Well, next. So the entry says 28.032. 28.032. 28.032. 28.032. So now we have this pattern. Okay, perfect. The second thing here is that we had that support level that actively was traded here. It was actually traded here. Let me place it here as well. And here we have that sign of, okay, I'm already in. I cannot do anything about that. I'm already in this trade, but this is a trading mistake. You see, lack of, how can I say it? It is a bit of lack of attention. I was not very attentive. First of all, this godly entry was our winner, the same support level. Second, this entry for BAT was our winner. Third, this level of resistance, yes, then broken. Then this B point showing respect to this level as well. And then these two large expansion bars breaking below this level. Large expansion bars breaking below. So odds are in the favor that this pattern will lose. Well, it is a mistake, but I am already in. I decided to step into this trade, and only then I noticed this support resistance. You see this? Even professionals make mistake. It will, I don't know, it will be a stop loss trade. I'm always sure. Almost sure, yes, it was. You can see it, yes? Boom, obviously. Do I know the future? No, I know the probabilities. If it is broken, it is broken. 18.7 and take profit could be what? 23.7. 18.7, 23.7. Nice risk to reward. 18.7, 23.7, and it is a loss. Could be a winner. Could be a winner. Okay. Continue. No, not a winner, could be a missed opportunity. Because of that simple basic stuff, simple that support resistance. If I break it to the downside, how stupid I was, what I was thinking about to place this trade. These large expansion bars, oh no, it will be a lesson for me not to do it next time. Write it down in my diary. I had this idea, I didn't watch the price action, was not attentive. Maybe was sleepy, maybe was something. Maybe was thinking about how to record the best video in the world, but not actually about how to trade. Was thinking about how to explain some concepts of psychology of trading. This is simple lack of focus, lack of concentration led to this loss. We could have no loss here, at least I could have no. Okay, let me move a bit faster. It seems to me, okay, this is the pattern, and now let me move it one by one. The pattern will not complete until we hit the B point and until we hit the C point. Okay, we have them both. First of all, what I want you to pay attention to is this. This is very interesting resistance. When we spike that through and then respect, the first one is the most important. Second, let me show it to you. Support resistance 127 at resistance 28.909. 28.909. Let me reverse that. 28.909. 28.909. Looks good, at least for now. 28.909. Let me go maybe back. What is this resistance telling me? Well, this resistance. Look. Okay, I'm a bit cautious about that right now. Okay, this resistance, this, and this. It was pretty good. so I am to break it. It all depends on the type of break. If it is a large expansion bar, then maybe I should stay away. Maybe I should stay away. Okay, let me move one by bar, yes, to see what happens. Let me see the price action. If it is moderate, if the price is moderate and then it shows some signs of weakness, then it may be a good trading opportunities. If it is not good, then it is not good. Okay, so guys, pay attention to this sideways movement. It is very long sideways movement. It should be the same number of bars within the here and here. They should be the same number of bars or shorter. And next, what I want you to pay attention to is this nice movement. Let us do the Elliott wave count. Wave number 1, deep retracement, yes. Wave number 3, consolidation retracement, yes. Odds are in the favor of wave 5 to the upside start. The conclusion: stay away. Do not enter this trade. Stay away. Okay, let us see what happens. If only the pattern triggers. Boom. You see? You see that? Consolidation. We've been consolidating. This is the resistance, another resistance. We've been consolidating just below that resistance. And then we broke to the upside. And we hit our stop loss. And the second Elliott wave confirmation, 1, 2, 3, blah blah blah, wave 5. Stay away from this trade. Okay, let's go next. No loss. Going next. Okay, we have some pattern here, and it is moving this way, bar by bar, bar by bar. Okay, what decision I should make? First of all, this is pretty good. Then we have a double bottom, let me put it this way, and then we broke to the upside, and now we retrace back to the same resistance level after we have broken to the upside. Well, odds are in the favor that we will continue. Why not? Pretty cool. Then let me, after that double bottom analysis, let me analyze the lines. So this is the support level. Not good. Well, no, not the one that makes me be very much preoccupied. Okay, I will enter this trade no matter what. 25006. 25006. Let me reverse the trade. 25006. The fibs. Oh, okay, come on. 25006. So I said, let me enter this trade. Yes, double bottom, pretty cool, broke close to the upside, and now let us see what happens. Bar by bar, bar by bar. Nothing bad, nothing bad. Simple price action, trending, downside trending bars. Okay, and you can see triggers, yes, and then goes to the upside. I suppose I need to zoom it in. Okay, yes, you see that, triggers and goes to the upside. that was the trade. In this trade I was risking what? 8.2 versus 10.3. 8.2, 10.3. 8.2, 10.3. It equals what I win. Okay guys, this is, I remind you, 15-minute time frame, and this is a very noisy time frame. So if you compare the time frame where 4 hour or daily 4 hour and daily time frames are much more accurate, they don't have those large boom to the downside, to the upside, to the downside, don't have those choppy movements. So if you first train yourself trading 4 hour and daily, only then you may switch to 15 minutes. I have just chosen the 15-minute time frame to show you the most difficult situations, trying to show you the most difficult situations, but I don't know what the market will show me. This is the problem. You never know what it will give you, what it will bring you, unless you have a crystal ball or whatever that will tell you the future, or unless you have a time machine. You just go to future and you say, you know what, the future will bring this and that. Okay, now let me show it to you. First of all, what we do have here, this is a double bottom. First of all, this is a double bottom. This is the V point of that double bottom, and it's not broken to the upside. It is not broken to the upside. If it were broken, then we have a shift to the upside momentum. We can have a shift to buy momentum. So it makes me a bit cautious. Then what we have next? We have this sloping trend line ray. Yes, sloping trend line. Okay, we cannot draw the next trend line. We only have 2 points. It will be expanding trend lines. It makes me cautious about the price action, the further price action. The previous example was pretty clear, and this price action makes me a bit doubtful. Should I buy it here? Let me first see my entry. 127 is this. It is above support. Well, pretty cool. 24, 10 and 7. 24, 10 and 7. 24, 10 and 7. 24, 10 and 7. Okay, so my decision is, well, if this trend line goes very close to my entry, yes, in case the consolidation moves sideways, yes, and I'm not in, then don't enter. If it triggers right now, then I still have some time, some room towards my trend line. And because the trend line is sloping and to the downside, I can also have it this way. You see, you don't know it until you get it. It may be a very nice pennant formation, yes, and if it breaks and closes below this B point and triggers your entry, it may be your pennant formation when you just don't have it. Well, no, it doesn't look like. My experience, my trading gods, I call my intuition, my experience, I call it my trading gods, because sometimes this is a level of subconscious knowledge, when you know something but you don't know why do you know it. You simply know, well, you know, I have some doubts, the market tells me something, the market is telling you something. Okay, the situation is doubtful, first of all, but there are not as many doubts as usual. Well, I would enter. Okay, decision is made, enter. If price action does not conflict to my decision, I will enter, if not, something else. Okay, moving sideways, breaking to the upside, and this pattern was invalidated. So my doubts were in vain. You see, that pattern was invalidated. Okay, and as I predicted, the price action broke to the upside. I had some feeling that it will break to the upside, but I was hoping that it will trigger me in. Okay, okay. Do we have some patterns? Oh, some pattern appears. Potential something. Cipher pattern, yes, I suppose. Yes, a potential cipher pattern. Okay, cipher pattern. The situation is the same, exactly the same level. Will the history repeat itself? Exactly the same level, but this time we sink a bit deeper. Then we made a double bottom once again, and this way we break and closed above this double bottom, and look at this wide range bar. The bar with this wide range closing above the double bottom's V line. This is a very bullish sign. Okay, cipher pattern giving me bullish signs. I don't even yet have the cipher pattern completed, but I already know that it has very bullish signs. Okay, let us see if the cipher pattern completes. Let me go here and place the entry for the cipher. I'm going to enter that. 786 is 124, 10 and 4. 124, 10 and 4. 24, 10 and 4. Okay, good. Now let's go here. Bar by bar. If price action will not consolidate, then hesitate or something like this, then I will be in. We've been consolidating here, broke to the downside. Consolidating here, broke to the downside, but that's okay. That's okay. Nothing wrong with that. Okay, long bar, wide range bar, but look at this, breaking nothing. We don't break this support. Wide range bar just at support. Nothing. Still my views on this market didn't change. My view is still entry. Triggered or not with this bar? Yes, triggered with this red bar. Okay, next bar. Who? Wow. Let me show it to you. Let me show it. Zoom it in. You can see that. Then next bar we made a bit lower, and then look at this price action to the upside. Look at that perfect bar. This is how the patterns work. They simply get you, boom, to your targets, straight to your targets. 20 and 8 versus 14 and 2. 14 and 2. Yes, 20 and 8 versus 14 and 2. 20 and 8 of stop loss versus 14 and 2 of take profit, and it should be calculated here. Okay, perfect. Let me zoom it out. I am to zoom it out more. Okay, now I have it. Okay, going next. Another cipher pattern, and before that cipher we will have that godly pattern. Okay, let me move it bar by bar. Okay, perfect. So guys, I want to pay your attention at this high. This high actually exceeds the B point of the godly. If it exceeds that, then the pattern is invalidated. The pattern should look this way. yes, the highest B point, and then it should look this way. You see that? So the true pattern should be that. In this case, you see market has fooled my algorithms, and it shows me some different. The market fooled me, fooled my mathematical algorithms. It says, I don't care about your mathematical calculation, I will do it on my own. And it did something strange. So that's why we don't have a pattern here. No entry with this Gatli. Okay, the only thing is left this cipher. First of all, what I tell about this cipher? Resistance, okay, gap here, and consolidating here. So we may have all those consolidations are typically just below resistance. Actually, the true resistance should be here. Okay, consolidating here before we break it. Now it looks good. Now resistance coincides here and here and here. Okay, I found it. The resistance is found. So if I enter here, yes, so I will need price to go back through this resistance level, and this makes me a bit skeptical about this trade. 24.92.3, 24.92.3. I am a bit skeptical. 92.3. Okay, but I will look at the price action. I will look at the way the resistance is broken, like this way. Yes, I will look if we consolidate just below the resistance. But I am very, very much skeptical about this trade. Maybe stay away. My first decision is to stay away, but maybe it will change as price action goes. Okay, stay away from that. Obviously, the price action breaks it. You can see this broken resistance, so stay away from this trade. And the reason for that is this simple double top, and this simple gap, and this simple consolidation, accumulation before breaking that resistance, and then retest of that resistance, and this break of that resistance. This all tells me that this is not gonna work. Then let us see if I'm correct or not. Okay, it did this. You can see it. Yes, didn't trigger and retraced back. I'm not in this trade. I'm simply looking at the price action. Maybe I was in a hurry to delete my orders. Maybe I was not good. Okay, look at this. Look at this consolidation period. Sorry. Look at the spike to the downside, unable to install a downtrend, and came back to that. So if I draw my resistance here, okay, if I draw it here, so just consolidation below the resistance is a bad sign. It's not a good sign. So selling above resistance is not good. So if I had some doubts, now I have no doubts. Stay out. I have no doubts to stay out. Okay, yeah, either way it didn't trigger. Okay, the resistance was not broken, it was a false breakout. Okay, but either way it didn't trigger. Going next. Oh, that's it, finished. Well, I wish I should I had to download some data, some historical data. Well, but if I would download some data, my video would be enormously large, and it is already large, but it would be very, very large. Okay, so although we don't have very many patterns, we have how many? 10 patterns. Well, not a very large amount of patterns, but still let's calculate our results. What we have so far: 4% generated, Each of this is 1%. 4% total generated. The number of trades is 10, and the losses, we have 1 loss, 2nd loss, 3 loss. Okay, 7 winners, 3 losses. One of those losses is very small loss, so almost 2 losses. Okay, so the probability of that is what is it? 70% right now. 3 losses out of 10 winners, out of 10 trades total. Okay, well, let's calculate some drawdowns. Let's start 10k, and let's calculate it this way. Every time we have 1% here, yes, so we should type this formula: previous plus 0.01%, yes, 1% multiplied that account, so we are risking only 1% of our previous account, and multiply this risk to reward, yes. If it is a positive number, we have some fraction of that winner, and if it is a negative, then we have that loss, yes. So we have it this way, then it goes this way, insert, then go to charts. Pretty cool. So this is a pretty nice moving equity curve. Let me do another calculation for you. This is called the drawdown calculation. It equals this. It equals if the account equals that less than our maximum, previous maximum, maximum for that, and our maximum account is that. If right now the account is less than our maximum account before that, then do the following. And what should we do? We should do the calculations. First, we should know the difference between the right now and the maximum account. Let's say we have a value right now, so we should know the difference between the current value and the last peak on our account, and we should divide it by our last peak as our account. Okay, and if it is not that, then type 0 or something like that, and you will see that right now. You see, this is calculating the drawdowns percentage. Okay, so no drawdown, 1% drawdown, then recovered, 1/3 of drawdown, then recovered, then 0.22% drawdown, recovered, 1% drawdown, recovered. Let us build the chart for our drawdowns, and you will see that how it looks like. Okay, as you can see, the largest drawdown is 1%. Pretty cool. 4% generated total, 4%. Here it is, the result, 4%. Yes, the sum of them is 4. 4% generated total, and the largest drawdown is 1%. And the average of that says 0.4. You see that? So on average, every trade is 0.4, regardless of that being a loss or being a winner. If we calculate the average, 0.4 on every trade. This is the expectancy. Well, okay, this was simple an example that demonstrates the approach. First, what I was talking about. The first thing, cut your losses short. You saw me, yes, the price is consolidating. It was showing some signs of I don't know, something of some chunk that it may not go into my favor. I just got out and I had minus 0.22, something like that, very small loss, instead of having a full loss, full stop loss. Next, I filtered some of the trades, simply having doubts. I doubt. We have double top here. That double top is a resistance, and my entry is above resistance. Who the hell is selling the above resistance? even if you sell above resistance, yes, look at the way that resistance was broken, how the price action came to that resistance, how maybe you had some expansion bars and resistance was broken by those expansion bars. Maybe you had it this way. Then pay very close attention to pennants, channels, consolidations, and blah blah blah. Pay close attention to these 1, 2, 3, 4, 5 wave count. They are simple basic stuffs. You don't need to know very complicated things like RSI calculations. I don't know really how the RSI is calculated. I know that the high of the candle is minus previous candle, multiply this, multiply that, standard deviation, plus blah blah blah, plus something else, plus volume. I don't know. I don't even know how MACD is calculated. Well, I know how MACD is calculated. It's the difference between the moving averages, converging, diverging. It is very simple. I don't know how ADX calculated. You know, the ADX indicator, it shows the power of a trend. I don't know how stochastic is calculated. I don't know this stuff. I don't understand it. What it shows. What is it? The combination of that. So you don't need to know that very complicated stuff. All you need to know is basics. Okay, simple basics. If you know the trending bars, uptrending bars, downtrending bars, yes, downtrending bars, uptrending bars, downtrending bars, uptrending bars. If they form a consolidation bars, you know how to draw the swings. You know how to relate the swings to each other, stretching the fibs. Measure the X to A leg, then measure A to B leg, B to C, and blah blah blah. Check those ratios according to my diagrams here, according to my description here, and you will have the patterns that I trade. Yes, but that's not all. Even if you have the patterns that I trade, even if you trade the same strategy, it's not a guarantee of that result, because I still use my brains. Although I have a mechanical system for drawing my patterns, I am still using my brains, and it was proved in today's video. You saw me thinking about every trade. You saw me making pros and cons about having that, calculating my risk. What if I will enter, what if I will stay away, and something blah 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 blah. Okay, you just saw it. When in doubt, get out, or when in doubt, stay out. You saw me. As soon as I had some doubts, I got out of the trade. As soon as I have some doubts, I didn't get in. I stayed out. Yes. So, but when in my trade and everything is okay, I don't have doubts. I let my profits run until price reaches my take profit. I'm not panicking. Oh no, you know what? Price is moving too fast. Maybe it will reverse, and my losses will, my winners will turn into losses. When price is going into your favor, you should let your winners run. At least until the take profit. Okay, so this was the lesson. If you guys are interested in my software, you are welcome to visit my website www.ps-software.net. On the home page, you will have that monster pattern search. There are 3 variations of that: manual, automated, and pro. Actually, the manual one is drawing patterns manually. Let me switch it to manual. You see, the algorithm is manual, and it will draw only those patterns that you show it, like this. You see, if the pattern is okay, it will draw. If the pattern is not okay, it won't draw anything. But me show you something, some example. Maybe a godly pattern. You see, now when it obeys, you can draw it on empty space or whatever. So this is manual. A manual is not bad. It is good if you know how to draw the swings, how to identify, if you know the basics. It is sometimes it is a bit better than automated one. You saw that automated, sometimes market is full in my automated algorithms, and it is showing the actual swing highs and swing lows, mismatching with what the indicator was drawing. Yes, my calculation says it should be here, but the market says I don't care what your calculations say, my swing high will be there. You see that? In this case, of course, manual is better, but nothing wrong with automated as well. If you don't know how to identify swings, the automated will draw the swings for you, and it will draw the patterns for you. If you don't know how to draw these patterns, if you don't know how to calculate them, if you don't know the structure of these patterns, well, it's not so bad. As long as you know the basics, as long as you know what is the difference between trend bar and consolidation bar, inside bar, outside bar, as long as you know some basic stuff of pennants, what are double tops, double bottoms, well, you don't need to know how those patterns are calculated, actually. You don't need to know all those algorithms that draw these patterns, how they are drawn. But you know that they are drawn in advance. You can see that. They are drawn in advance. This, you see, price action does not coincide with this because this point is not taken from history. This point and this point is calculated point, and either price goes to this calculated point, respects that, or it doesn't. Well, you can see it. Price may never come there, or it may come and spike it through. So, or it will respect or not, because it is not the level that is taken from the price, it is the level that is calculated. If you have this swing, you have second swing, and you have the third swing, the swing number 4 should terminate here, and according to the calculation it draws the numbers, and it draws the second triangle where to terminate. But it doesn't know if it will terminate there or not, if it will go there or not, if it will reverse there or not. Okay, well, so, but it's not a guarantee that you will start trading immediately like I am. So the simple fact that you just get the same software that I have, that you identify the same patterns that I have, it's not a guarantee. And to compare these two things, I wanna use the next similar that I like most. It is the same as using the bicycle in a competition. For example, I am an Olympian champion and you are an average man, a bit overweight, and we both have the same bicycles, identical, the best bicycles on earth. Carbon or something made of those futuristic materials, and I am a winner and you are not. Why? Because I practice with my bicycle day and night, day and night, day and night, day and night, and I have a feeling of what is working, what is not working. And you never practice that. You will require some practice with this as well. Well, hope you understood this metaphor. Guys, one important announcement for you. I am going to make a webinar in the beginning of February. So most likely it will be a Skype webinar in the form of Skype conference, when we just get together, yes, and we just talk via Skype. And then we just do what? Then I will share my screen, you will be watching it, and I will explain you the setups, how to draw them, how to identify them, how to do this, how to do that. I will explain you the secrets of trading. I will explain you how what you should do in this situation, in that situation, how simply just share my experience with those patterns. And you know that with the software that I have, you see that I can do those tests of my patterns. They are drawn. I don't need to spend my time for drawing them. So you can be sure that I know a lot about those those patterns. Okay, so I'm willing to share my knowledge with you. And the only thing is that the Skype is limiting the number of participants up to 25, as I remember. It is a limited number. So stay around, stay in touch to get the announcement and to participate in that Skype conference that I'm going to have in the beginning of February. It will be absolutely free. Nothing is needed, only your desire. Just contact me and say, okay, I want to use your Skype webinar. I want to be a participant of your Skype webinar. Well, next, what is next? Blah, blah, blah. That's it. Okay, if you like this video, and I hope you like it, because plenty of you are already amateur traders. You already have that strategy. You know the rules for how to trade in them, but you cannot shift that, make that shift towards the professional. You cannot make your equity curve to start steadily rising. You have winners and then you give them back. You have winners, then you give them back. So in today's video, I was telling in how not to give back your profits, how cut your losses, how to stay out of trades. And this was mostly a psychological video. Don't get my rules as for granted. You see, this is only an example of how you can cut your losses. This is simple an example. This is not the rules that should be taken for granted, that should be always followed this way, something like that. No. They are the guidelines, not the strict rules, the guidelines. Be cautious in this situation. Warning signs here, warning signs there, doubtful situation here, doubtful situation there. This was about this. And your task as a professional trader is to only enter those trades that are guaranteed, that are no doubts. It's not. It doesn't mean that it is a guaranteed winner. The trading opportunities with no doubts. I mean that nothing is telling you that it may not work. Everything converges good. Everything complements each other. All the bits of the puzzle come together. Nothing is conflicting. So this is what is called money line on the table. Just wait for those situations to appear. But when you have those situations with lots of doubts, of course, you will be taking the trades that will be taking your profits away. You will be donating profits to the market. Although the strategy is powerful, but you still cannot generate the money. It is the same as the Jaguar. If you know the Jaguar, I have read the story in Jack Schwager's book Market Wizards. He was interviewing some trader, and this trader said that although the Jaguar is the fastest animal on planet, the Jaguar, what is the Jaguar? Let me find it for you. I'm not sure if it is pronounced this way. Animal. Jaguar animal. Okay, this one. This animal is called a jaguar. Although it is the fastest animal on earth, it will be sitting behind the bush, under the bush, hiding and waiting for some animal which is weak, which leg is broken, or maybe it is ill. The animal that has absolutely no chances to survive. And only then he jumps and gets that. But you know, it is the fastest animal on earth. It can, I don't know, it can run faster than whatever antelope, whatever deer, whatever animal. It can run easily, but it is still waiting for the best opportunities. Not all antelopes are good, not all deers are good, but only those that are weak, only those that are maybe broken legs or something like that. Only those that are small, like baby deers. Only then he jumps and eats that. So this is the professional approach versus amateur approach that is trying to enter every single situation. And I like that similar very much as well. So if you like this video, please share this video on social media. Maybe there are lots of your friends that are also looking for some ways to improve their trading results, their psychology, and then other stuff to make that shift from amateur trader to professional trader. Give me your thumbs ups, comment below. Maybe you have some ideas, share it with me. And if you are interested in my software, you're welcome to visit my website. Until then, good luck and good trading. Hope to see you soon.